Look, I need to show you something that most financial advisors won't tell you about your 401k. And I'm not talking about the usual advice about diversification or rebalancing. I'm talking about a fundamental shift that's happening right now in the global financial system that could determine whether your retirement savings survive what's coming or get decimated. Let me start with a question. Do you know what happened to 401k accounts during the 2008 financial crisis? The average account lost 27% of its value. But here's what they don't tell you. Some people actually grew their wealth during that same period. How? They understood something that most investors completely missed. Right now, we're seeing warning signs that make 2008 look like a dress rehearsal. And the secret to protecting your 401k isn't what you think. It's not about picking the right stocks or timing the market. It's about understanding what's really happening behind the scenes in the financial system. Let me take you back to a moment in history that changed everything. August 15th, 1971. President Nixon walks into the Oval Office and makes an announcement that would reshape the entire global economy. He's closing the gold window. No longer can foreign governments exchange their dollars for gold. In that single moment, the dollar became what we call a fiat currency, backed by nothing but faith in the government. Now, why am I telling you this? Because we're living through the consequences of that decision right now, and your 401k is sitting right in the crosshairs. Here's what's happening. Since 1971, the dollar has lost over 98% of its purchasing power. Think about that. If your grandparents had $100,000 in cash in 1971, it would have the buying power of less than $2,000 today. But here's the thing. Most people's 401k accounts are denominated in dollars. They're invested in dollar-based assets, stocks, bonds, mutual funds, all priced in a currency that's been losing value for over 50 years. And the pace is accelerating. In the last 4 years alone, we've seen inflation rates that we haven't experienced since the early 1980s. Your grocery bill knows it, your gas tank knows it, but your 401k statement, it might show a number that looks okay on paper. But what's that number really worth? Let me show you something that's happening right now that should terrify anyone with retirement savings. Central banks around the world are dumping U.S. Treasury bonds at a record pace. China has reduced its Treasury holdings by over $300 billion in the last 2 years. Japan, traditionally one of our biggest creditors, is selling. Even smaller nations are diversifying away from dollar-denominated assets. Why does this matter for your 401k? Because when foreign central banks sell treasuries, it puts upward pressure on interest rates. Higher interest rates mean lower bond prices, and most 401k accounts have significant bond allocations, especially if you're approaching retirement age. The traditional 60-40 portfolio, 60% stocks, 40% bonds, that financial advisors have recommended for decades, it's getting crushed from both sides. But here's where it gets really interesting. While these central banks are selling treasuries, they're buying something else. Gold. Lots of it. In fact, central banks purchased over 1,000 tons of gold last year alone. That's the highest level of central bank gold buying in over 50 years. The People's Bank of China has been adding to its gold reserves for 18 consecutive months. Poland increased its gold reserves by 100 tons. Singapore, India, Turkey, they're all accumulating gold at unprecedented rates. Now, these aren't amateur investors. These are the most sophisticated financial institutions in the world with access to information and analysis that you and I will never see. And they're making a very clear statement about where they think the global financial system is headed. Let me tell you a story about a man named John. John was 58 years old, had been diligently contributing to his 401k for 30 years. He had about $800,000 saved up. Not bad, right? He was planning to retire at 65. Then 2008 hit. His account dropped to $580,000. He panicked and sold everything, locking in his losses. It took him until 2013 to get back to where he was. But here's the kicker. By the time he finally retired at 67, inflation had eaten away so much of his purchasing power that his $800,000 had the buying power of what $600,000 would have had when he started planning his retirement. John's story isn't unique. It's playing out in millions of households across America. And the next crisis could be even worse. Here's why. The Federal Reserve has painted itself into a corner. They've got over $7 trillion on their balance sheet from years of quantitative easing. The national debt is over $36 trillion and growing by about $1 trillion every 100 days. Think about that. Every 100 days, we're adding another $1 trillion to the national debt. That's not sustainable. Something has to give. And when it does, Your 401k is going to feel it. Because here's the dirty secret about 401k accounts. They're designed to keep you invested in the system. You get tax benefits for putting money in, but there are penalties for taking it out early. You're essentially locked into dollar-denominated assets, watching the value of the dollar erode year after year. Now, I'm not saying you should cash out your 401k and stuff money under your mattress. That would be financial suicide. But what I am saying is that you need to understand the game that's being played and position yourself accordingly. Let me show you what the smart money is doing. Institutional investors, the big hedge funds, family offices, sovereign wealth funds, they're not putting all their eggs in one basket. They're diversifying into hard assets, real estate, commodities, and especially precious metals. Why? Because these assets have intrinsic value that doesn't depend on government promises or central bank policies. Look at what happened during the 1970s. That was the last time we saw sustained high inflation in the United States. From 1971 to 1980, gold went from $35 an ounce to over $800 an ounce. That's a 2,200% increase. Meanwhile, the stock market was essentially flat for the entire decade. If you had your retirement savings in stocks during the 1970s, you lost money in real terms after accounting for inflation. But here's what's different now. The situation today is actually worse than the 1970s in many ways. Back then, the national debt was manageable. The Federal Reserve had room to raise interest rates to fight inflation. Paul Volcker raised rates to 20% in 1980 and broke the back of inflation. Can the Fed do that today? Absolutely not. With $36 trillion in debt, every percentage point increase in interest rates adds hundreds of billions to the annual interest payments on that debt. We're already spending more on interest payments than we spend on defense. If rates went to 20%, the government would be bankrupt. So what's the Fed going to do? They're going to print more money. They're going to inflate away the debt, and your 401k is going to pay the price. Now, here's something most people don't know. You actually have options within your 401k that can help protect you from this. Many 401k plans allow you to roll over funds into a self-directed IRA, which gives you much more flexibility in what you can invest in. And some of these self-directed IRAs allow you to hold physical precious metals. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I've put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties or early withdrawal fees. Worth checking out if you want to explore this option. But let me get back to why this matters right now. We're seeing a convergence of factors that we haven't seen in decades. High inflation, massive government debt, geopolitical tensions, central banks buying gold, foreign countries moving away from the dollar. All of this is happening simultaneously, and it's creating what I call a perfect storm for traditional retirement accounts. Let me give you another example. In 2011, we had a debt ceiling crisis. Remember that? The U.S. government came within hours of defaulting on its debt. What happened to gold during that period? It hit an all-time high of over $1,900 an ounce. Why? Because investors were fleeing to safety. They were looking for assets that couldn't be printed into existence by central banks. Now fast forward to today. We're facing another debt ceiling crisis. We've got wars in Ukraine and the Middle East. We've got tensions with China over Taiwan. We've got a banking crisis that saw multiple regional banks fail. And we've got inflation that, despite what the government tells you, is still eating away at your purchasing power every single day. Your 401k is invested in a system that's showing cracks, and those cracks are getting bigger. Here's what really concerns me. Most people look at their 401k statement and see a number, and they think that number represents their wealth. But that number is just digits on a screen. What matters is what those digits can buy, and what they can buy is shrinking every year. Let me put this in perspective. In 2000, the average new car cost about $22,000. Today, it's over $48,000. That's more than doubled. In 2000, the median home price was about $170,000. Today, it's over $400,000. More than doubled. But has your 401k more than doubled since 2000? Maybe if you've been lucky and aggressive with your investments. But for most people, their retirement savings haven't kept pace with the real cost of living. And here's the scary part. This is during what's supposed to be the good times. We haven't had a major financial crisis since 2008. The stock market has been on a historic bull run. If your 401k hasn't kept pace with inflation during the good times, what's going to happen when the next crisis hits? Because make no mistake, another crisis is coming. It's not a matter of if, it's a matter of when. The question is, will you be prepared? Let me tell you about another person I know. Her name is Sarah. Sarah is 52 years old, and she learned about this stuff back in 2019. She had about $600,000 in her 401k, all in traditional stocks and bonds. She decided to diversify. She rolled over a portion of her 401k into a self-directed IRA and allocated 25% of it to physical gold and silver. Her financial advisor thought she was crazy. "You're being too conservative," he said. "You're missing out on gains." Then 2020 happened. The pandemic hit. The stock market crashed 35% in a matter of weeks. Sarah's traditional holdings got hammered. But her precious metals? Gold shot up to over $2,000 an ounce. Silver nearly doubled. That 25% allocation to precious metals cushioned the blow and actually helped her portfolio recover faster than the market average. But here's the real kicker. When inflation started surging in 2021 and 2022, while everyone else was watching their purchasing power evaporate, Sarah's precious metals allocation continued to hold its value. She's now 52, and she's on track to retire comfortably at 60, while many of her peers are talking about working into their 70s. What did Sarah understand that most people don't? She understood that diversification isn't just about owning different stocks. Real diversification means owning different types of assets that respond differently to economic conditions. When stocks go down, bonds are supposed to go up. But what happens when both stocks and bonds go down at the same time? That's what we saw in 2022. The traditional 60-40 portfolio had its worst year in decades. But precious metals? They moved independently. They provided a hedge against the very forces that were crushing traditional portfolios. Now, I want to be clear about something. I'm not saying you should put all your money into gold and silver. That would be just as foolish as putting all your money into stocks. What I'm saying is that you need to think about your 401k differently. You need to think about it not just as a number on a statement, but as your purchasing power in retirement. And you need to protect that purchasing power from the forces that are working against it. Those forces are real, and they're accelerating. The money supply has increased by over 40% since 2020. That's not a typo. 40%. More dollars chasing the same amount of goods and services. That's the textbook definition of inflation, and it's not going away anytime soon. The government will tell you inflation is under control. They'll point to the CPI numbers and say it's coming down. But have you looked at how they calculate CPI? They've changed the methodology multiple times over the years, always in ways that make inflation look lower than it really is. They use something called hedonic adjustments and substitution effects. Basically, if steak gets too expensive, they assume you'll buy chicken instead, and they count that as no inflation. That's not how real people live. Real inflation, the kind you experience when you go to the grocery store or pay your utility bills or try to buy a house, is much higher than what the government reports, and your 401k needs to be positioned to deal with that reality, not the government's fantasy numbers. Here's another thing that keeps me up at night. The commercial real estate market is in serious trouble. With remote work becoming permanent for many companies, office buildings are sitting empty. Commercial real estate loans are coming due, and many property owners can't refinance because the buildings are worth less than the loans. This is creating stress in the banking system. We've already seen some regional banks fail because of their exposure to commercial real estate. Why does this matter for your 401k? Because many 401k plans have exposure to real estate investment trusts, or REITs. And many of those REITs are heavily invested in commercial real estate. When those properties lose value, your 401k loses value. But it goes deeper than that. When banks get stressed, they pull back on lending. When lending contracts, economic growth slows. When growth slows, corporate profits fall. When profits fall, stock prices drop. It's all connected. And your 401k is sitting right in the middle of this interconnected web of risk. Now let me show you something that's happening in the derivatives market. This is where things get really scary. The total notional value of derivatives contracts worldwide is estimated at over $600 trillion. That's not a typo. $600 trillion. That's about 7 times the entire global GDP. These are complex financial instruments that are supposed to manage risk, but they actually concentrate it. And when something goes wrong in the derivatives market, it can cascade through the entire financial system in a matter of hours. Remember 2008? That crisis started with subprime mortgages, but it spread through the financial system via derivatives. Credit default swaps collateralized debt obligations. These complex instruments turned a housing problem into a global financial meltdown, and the derivatives market today is even bigger and more complex than it was in 2008. Your 401k might not be directly invested in derivatives, but the institutions that manage your money certainly are. The mutual funds, the ETFs, the pension funds, they all use derivatives for hedging and speculation. And when the next crisis hits, those derivatives are going to amplify the losses. This is why diversification into hard assets makes so much sense. Physical gold and silver don't have counterparty risk. They're not someone else's liability. They can't be printed into existence. They can't default. They just are. And in a world of increasing financial complexity and risk, that simplicity is incredibly valuable. Let me give you some specific numbers that should concern you. The average 401k balance for people in their 60s is about $200,000. Sounds decent, right? But think about what that means. If you retire at 65 and live to 85, that's 20 years of retirement. $200,000 divided by 20 years is $10,000 per year. Add in Social Security, and you might have $30,000 to $40,000 per year to live on. Can you maintain your lifestyle on that, especially with inflation continuing to erode your purchasing power? And that's assuming your 401k doesn't lose value in the next market crash. If we have another 2008-style crisis and your account drops 30%, suddenly that $200,000 becomes $140,000. Now you're looking at $7,000 per year from your retirement savings. That's poverty level. This is the reality that millions of Americans are facing. They've done everything right. They've saved diligently. They've followed their financial advisor's advice. They've stayed invested for the long term. But the system is rigged against them. The constant erosion of the dollar's purchasing power, the boom and bust cycles of the stock market, the fees that eat away at returns. It all adds up to a retirement that's far less comfortable than what they were promised. But here's the thing. You don't have to be a victim of this system. You can take control. You can diversify into assets that have held their value for thousands of years. You can position your retirement savings to not just survive the coming crisis, but potentially thrive during it. Think about what happened during the Great Depression. Stocks crashed 89% from peak to trough. Bonds defaulted. Banks failed. But gold? Gold was revalued from $20 an ounce to $35 an ounce by the government. People who held gold not only preserved their wealth, they actually increased it in purchasing power terms while everyone else was being wiped out. Or think about the 1970s again. Stocks went nowhere for a decade, but gold went up 22 times. People who had even a modest allocation to gold in their portfolios came out way ahead of those who were 100% in stocks. History doesn't repeat, but it rhymes. And right now, we're seeing the same patterns that preceded every major financial crisis of the past century. Excessive debt, monetary expansion, geopolitical tensions, loss of confidence in fiat currencies. It's all there. The question is, what are you going to do about it? Are you going to keep all your eggs in the traditional 401k basket and hope for the best? Or are you going to take action to protect your retirement? I'm not a financial advisor, and I'm not telling you what to do with your money, but I am telling you to educate yourself. Understand the risks you're facing, understand the options you have, and make informed decisions based on reality, not on what the financial industry wants you to believe. Because here's the truth. The financial industry makes money when you stay invested in their products. They make money from management fees, trading commissions, and all sorts of other charges that eat away at your returns. They have a vested interest in keeping you in the system, even if that system is working against your best interests. But you don't have to play their game. You can diversify into assets that they don't control. You can take physical possession of real wealth that can't be manipulated by central banks or Wall Street. You can protect yourself from the coming storm. The secret to protecting your 401k isn't some complex trading strategy or some hot stock tip. It's understanding the fundamental forces at work in the global financial system and positioning yourself accordingly. It's recognizing that the dollar is losing value and will continue to lose value. It's understanding that traditional diversification isn't enough when the entire system is at risk. It's taking action to protect your purchasing power, not just your account balance. Your retirement is too important to leave to chance. The decisions you make today will determine whether you retire comfortably or struggle to make ends meet, whether you maintain your lifestyle or have to drastically cut back, whether you leave a legacy for your children or leave them with nothing. The time to act is now. Not next year, not after the next crisis hits. Now, because once the crisis is in full swing, it will be too late. Precious metals will be expensive and hard to acquire. The opportunity to protect your wealth will have passed. Don't let that happen to you. Take control of your financial future. Educate yourself about your options, and make the moves necessary to protect what you've spent a lifetime building. Your future self will thank you.